It's the 19th of June, and you're listening to Kopi Time, a podcast on economies and markets from DBS Group Research. I'm Taimur Baig, Chief Economist. In recent weeks, our theme has been investment. Last week, we spoke with Frank Engels, the CIO of Germany's Union Investment, to discuss the outlook for euro area assets. The week before that, we had discussed responsible investing with Panarchy partners Munib Madni. So we will continue with the investment theme. Today, we will delve into the world of private equity and real estate. To do that, we have with us Atul Kapur, co-founder and the current chief investment officer of the Everstone Group. Everstone is a private equity and real estate investment firm. It works with entrepreneurs, corporations, and asset owners across India and Southeast Asia. Founded in 2006 by Atul and Sameer Sain, Everstone has a large institutional platform and a team of over 350 professionals based in Singapore, Mumbai, Delhi, Bangalore, London, New York, and Mauritius. Everstone manages assets in excess of $5 billion across private equity, real estate, green infrastructure, and venture capital. Before founding Everstone, Atul spent 12 years at Goldman Sachs, where he was managing director in the Principal Strategies Group based out of London. Atul also worked in the Principal Investment Area Group of Goldman in both Asia and Europe. Atul Kapur, with great pleasure, I welcome you to Kopi Time. And to paraphrase Lewis Carroll, let's begin at the beginning. 15 years ago, you had a successful and secure career at Goldman Sachs in London, working on investment strategy. What made you go the entrepreneur route?
Thank you very much for having me on your podcast, and I'm honored to be here. My journey, at Goldman Sachs, anybody who has managed capital or who continues to manage capital, and I use broad generalizations, wants to be an entrepreneur and manage capital on their own. Whilst Goldman is just a fabulous, fabulous place to grow up and build a career and be successful, I think most people who either manage money either for the firm or manage money on behalf of clients of the firm all harbor a desire to be entrepreneurial, and I was no different. I think people had to find the right construct, because it's very easy to entertain the notion of being an entrepreneur, but it's a very hard one to pull off in a sensible, structured fashion. And I think I was extremely, extremely lucky that I found a like-minded partner who was also at Goldman Sachs with me. He was a friend of mine, and we've been friends since he joined Goldman in 1995. And it wasn't until almost 11 years later where, through multiple conversations in many coffee shops that we had, that we got together to come up with a construct that we thought really could work. And I must say that he was right, and here we are 14 years later, having built what I think is a reasonably successful firm. So I think everybody harbors a desire, and I was no different, but it takes a combination of good luck, a great partner, and a lot of hard work.
So walk us through a little bit about that early hard work. You move from the Goldman ladder to sort of starting anew, if you will, and you talk about your partner Sameer Sain, and you going from discussions on coffee shops to actually starting to raise capital. How does one go from that dream to actual dollars in the bank which can then be deployed?
Listen, the first caveat that I would place and put here is that 2006, when we left Goldman Sachs, it was a different world. So this was way before even the great financial crisis, and we are kind of in a second crisis, and so the world looks very, very different. But I think we were in a world of surplus liquidity at that point in time in 2006, and bizarrely enough, the markets were peaking 06, 07. There was never a better time to leave. There was never a worse time to leave. Worse because we gave up a lot when we left Goldman, but never a better time to leave because the world was awash with liquidity. And I think our journey, the first bit of luck that we had was that we got the backing of Goldman Sachs, the firm, who decided, as Sameer and I were leaving the firm, to back us with their capital. And once that momentum came, it helped us really raise our first fund at a rapid clip, because the world at that time did and still does think very highly of Goldman's ability to pick people that they want to back. So I think we got a significant wind in our sails with Goldman backing us. And we started with our first fund, which is a private equity business, which was focused predominantly on India at that point in time. And our construct was that we would back India, if you remember back again 14, 15 years ago, the post waves of liberalization, there was great expectations that India would finally break its sort of socialist shackles and adopt a more open Western style of an economy. And capital was flooding in to provide much needed fuel for growth for young entrepreneurs who could feed into the different sectors of the economy as that was bounding ahead. So our strategy at that point in time was to feed into the sort of the great consumption dream in India 14 years ago, and with the capital that we had, we set about to deploy it. So that was the first fund. We moved from there into the second stage of our investments, where as we looked at a variety of different sectors to invest in, we found there were yawning gaps in the market in terms of mixing capability with capital, and real estate was one of them, and that was the second fund that we set up within sort of a year and a half of our setting up the first fund. And I can talk to it as we sort of go through the different strategies that you have, that different questions that you will ask. I'll go through all our different strategies that we currently deploy. So I think look, the entrepreneurial journey is not an easy one. I think stepping out from the cocoon and comfort of a large institution like Goldman Sachs, where you take a lot for granted, whether it's access to capital, it's access to human resource, it's meeting with like-minded people, just the quality of individuals that you engage with, both at a peer level, at a senior and a junior level, just tends to be very, very high. So, and I'm sure I speak with most large financial institutions globally. And I think when you step out, you find that safety net of capabilities isn't there. And you have to do pretty much everything yourself. Come up with an HR policy, hire yourself, make sure after you've hired people that you keep them with you. And if you remember 2006, in that sort of great wave of liquidity, there was a dearth of talent but no dearth of capital. I think the world is a different place right now. And for a young firm to attract high quality capital, high quality talent, was just not easy, because anybody who had, was recruitable, had 16 different options available, from hedge funds to investment banks to all sorts of different investment pools that were sloshing around in those markets. So I think that if I look back and I see the toughest thing that we encountered was actually putting talent together. And over the last 14 years, whilst we have consistently raised capital, our talent journey still remains, I would say, we're only 75% of the way through. Because if you see the underpinnings of an asset management business, it's capital and talent. Capital we always can raise. Talent is just difficult, and ours unfortunately is a longer dated race compared to the public markets, because our typical hold periods for assets tends to be 4 or 5 years. So consistency of teams and consistency of effort of those teams is a huge issue. So I think that, to me, if I was to look back and say what has been the toughest part of the journey, it's been that. Just identification, and then hiring, and then keeping talent wedded to the goal and wedded to the journey has been, I think, the toughest part of our business.
So Atul, we will talk about your company's strategy around India and the strategy around real estate through the course of this discussion. But first, let's talk a bit general about your industry. And by that, I mean the private equity part. It's got a bit of an element of mystery associated with that, and in recent years has attracted some criticism. So help us demystify the inner workings of a private equity firm.
I think there's more myth to it than reality, because if you look at the building blocks of any investment effort, I don't think they are radically different if you are investing in the public markets or if you're investing in the private markets. You are hunting for high quality businesses that have defensible moats, that have an element of growth that you can bank and underwrite, that have margins that are sustainable, that you think that with some intervention you can either make the revenue grow faster or get some operating leverage to make the profitability go faster whilst the business continues to be defensible. I think that at that sort of that's the first filter in the framework, that whether you're in the public or the private markets, you use that. I think where things start becoming, as people sort of want to keep this in a black box, is the intervention bit. And again, if you look at private equity from a minority growth perspective, it's not radically different than public market investing, with one exception, that exits are harder to pull off. But honestly, if you're backing a bunch of promoters or entrepreneurs as in a minority position, at best you can be supportive capital, but you can't be interventionist. What we tend to do, and where the big private equity firms globally, what they tend to do is have a very interventionist approach, which is they will buy a business, and the investment thesis is in that acquisition is reasonably clear at the beginning, and most of the time it is how do you wring, as in ring with a W, results out of what you've bought, and therefore the interventions have to be at multiple levels, whether it is from a growth perspective, it is from a margin perspective, it is from an efficiency perspective, in terms of exploiting the capabilities of the business better, better utilization of working capital to release cash, or it's bringing better talent to work across all levels of the organization. So I think for the passive investing world, it just seems to be kind of a very different world that the private equity guys inhabit, just because what they do in a company is radically different than what the passive investors tend to do. Also, I think private equity folks, when they write up their investment thesis, I think the level, leaving aside the financial engineering bit, I'll come to that in just a second, I think that the development of the investment thesis has to be multidimensional. It can't just be around growth or profitability. It has to be around what do you do with this business that makes it more attractive for the next buyer coming through. And remember, in a controlled situations, you're buying the whole business to sell the whole business. So you really have to think through those elements. So I think I call it peeling of the onions, the layers that you have to unpeel before you get to the meat. And I think in the public markets, you probably unpeel 2 or 3 layers of the business. You do your diligence on the business, your channel checks, you look at what competitive businesses are doing. But there's only so much you can do in terms of really assessing capability and qualities by looking into the business or all aspects of the business. That's the first. And second, even after you unpeel sort of the 3 layers of an onion, if your assessment of what you see is wrong, the only ability that you have, keeping aside activist investing styles, the only alternatives that you have is to exit. If you don't like what the management is saying or doing, you vote with your feet. I think in the private equity world, it's different. You're long and you generally can't be wrong. And therefore, you peel 6 layers of the onion, and even then you can be wrong. But as you peel these layers of the onions, you have to have points of view at every level, from an organizational structure point of view, from a sales force optimization point of view, from an economic incentives throughout the organizations as to how they work, and how do people work to get you whatever your end results are. So I think the level of sort of deep dive that most private equity firms tend to take is a lot more than what passive investors tend to do or make. And this is not meant in any disrespectful way, but that's just the nature of the business.
So even activist shareholders like Bill Ackman, you would say that their sort of top-down intervention in a company is still 2-3 layers, not 5-6 layers like yours.
I think the difference is that we get to do, Taimur, we get to do complete diligence on a company. Everything from every legal contract the company has entered into. We can review the contracts of every employee in the organization, which we don't, but the complete sort of CXO suite we can look and interview and speak with 3 levels of management deeper into the organization. We can let loose accountants, consultants, and lawyers to map the company's positioning in the market, not from an outside in perspective, but from an inside out perspective. So I just think that access to information, that doesn't mean your decision making is any better, but start with the access to information, and that's just way more than you can get on an outside in perspective. So I think then the difference between the good private equity firms and the bad private equity firms, good and bad as evidenced by the returns they generate, is then what do you do with the information? How do you actually make an investment decision that whether or not you want to buy an asset? But it doesn't stop there. It is after you've bought the asset, what do you do with the asset that ultimately delivers returns to you? And the last bit of sort of the last arrow in the armory, in the quiver, is your ability to do financial engineering in a business that you acquire, which if you are a passive investor in the public markets, there's very little that you can do. You can buy a leveraged company and there's embedded leverage in that business, but you can't really do all the financial engineering and capital structuring that you can, which in some cases delivers a significant portion of the returns, and in dislocations in the markets, detracts from a significant portion of the returns that you generate. So I think I'm not sure there is a lot of mystery behind what private equity guys do. It is true that the compensation styles of these private equity folks, just because of the nature of the market, in terms of forget the fee, but the fact that you can participate to a large extent relative to the public markets in the upside that you generate for your investors. I think what that does is it sort of takes the private equity crowd, because the path to riches for the successful guys, at least in the Western world, has been reasonably rapid, and that puts them on a pedestal. There are many billionaires in the private equity and the hedge fund market. There aren't so many billionaires in a long only market, and part of that is just the nature of the structure of the economics of the business. Now the question, of course, is why do these guys get paid more versus if you are a good enough or a smart enough investor in the public markets? And I think it boils down to leaving aside what returns you generate, and that's the constant tussle in the markets, because in theory private equity is supposed to deliver real alpha, because beta you can access through ETFs, and now you can access through really relatively low cost options. So why would you pay full fees and a 20% of the carry structure to the private equity folks unless they can really drive alpha? And I think that as most private equity firms, and we're no exception, like to at least continue to market ourselves as true alpha generators in a relative to any benchmark that you will have. So I think the success stories in the private equity world, especially in the Western private equity world in the US, abound, and the characters who personify that are larger than life, and then myths get written about them and myths get created around them.
Correct. And want to go a little deeper on the issue of the financial engineering. The general sort of narrative in the market is the leverage aspect. That you engage with a company, you champion their expansion, and the expansion is championed, at least on the capital side, by leverage. So one example that you and I sort of exchanged emails about recently was the Hertz bankruptcy case. Wall Street Journal wrote a big story about it just a few days ago, talked about that the fatal mistake for Hertz was the leverage acquisition of Dollar Thrifty, and how that debt-driven expansion model was the reason why sort of Hertz went bankrupt. Is it a typical story? Is it a private equity specific story? I mean, how do you sort of look at this whole Hertz story from overall sort of perspective on the industry?
I think leverage is not a particular and specific domain only of private equity. I think the perils of low interest rates manifest itself into many I'm searching for the right word, but bad behavior. Okay, so efficient capital allocation, and what's the most efficient use of capital that a company can allocate. So there have been many instances where, and it's been true of the last 10 years, that, and you can argue that for companies to raise debt in the markets to do share buybacks is just on one hand, it's a great decision if you can raise funds cheaply, but every time there is a dislocation in the market, it turns out that it's a poor decision. So I think leverage is a double-edged sword, and you have to really use it very, very judiciously. And how much is enough? Function of the leadership of a business as to what they think is right for all stakeholders and not necessarily shareholders, because when companies lever up too much and they die, the stakeholders, which are the employees, are the first ones to suffer in addition to the shareholders. But when they lever up and do share buybacks, it's only the shareholders that benefit. So I think leaders have to decide on what the optimal use of capital is. I think private equity tends to have a more, I won't say sophisticated, but they tend to have a slightly more aggressive view of the use of leverage. In any market, there are excesses, and what happens is that until there is a spectacular bust which people can point to, and then the press sort of feeds off it, these practices continue. So I'm not sure that this is an exclusive preserve or bailiwick of the private equity folks, which is poor decisions to use leverage to make acquisitions, or poor decisions to use leverage to do shareholder buybacks. But what happens is that when private equity firms collapse, it's an easy target to point to, because the public's perception, I'm not sure who, I think the German finance minister 10 years ago, I think after the great financial crisis, called them vultures. And all they are known for is asset stripping and or cut cost cutting and firing workers to increase profitability. And I'm not sure. Listen, in every industry, there are poor practices. I won't say bad, but poor practices. And the private equity industry is as guilty as any other for making poor decisions and poor choices. But if you think and if you have lived and grown up in Asia, the only thing, and where access to the debt markets has historically been poor, the only hat that you can hang when you're looking at a potential investment, the only thesis that works is growth. And so financial leverage does play a part, especially if you have the ability to access pools of capital where interest rates are low. But most sort of Asian private equity firms will tend to focus on growth ahead of financial engineering. Financial engineering in low growth markets, when you're buying mature businesses, how do you wring juice out of that investment, especially if you're targeting a mid-teens return, and the cost of leverage is sub 4%. The spread between what you can get, what you can in theory get for your equity versus where you can borrow leverage in your capital structure, I just think that the attraction is too much. I think the second problem, if you ask me, also is when there is, it's the problem of plenty. When there is too much liquidity in the system, standards tend to drop. And we all have been hearing that one of the biggest issues in the GFC, and then it sort of corrected for a while, and then again it lapsed into its original phase, is just the covenants around debts that when you raise. So what gets a lot of the companies into trouble is a lack of tight covenants that keep these companies and the borrowers down the straight and narrow. So if you have very loose covenants, you just are tempted. It's like taking a kid into a candy shop, right? You can tell them to be self-disciplined, and they'll remain self-disciplined for 5 minutes, and after that, people tend to go crazy. So I'm not putting the blame at by any means at the door of the lenders, but I think this thing goes hand in hand. When there is excess liquidity, people can see that they can, the markets will afford you an opportunity to borrow. Poor practices creep in, and whenever there is a spectacular bust, the narrative goes back to the gang of vultures who do nothing but asset stripping. So that's my view on where the markets are.
No, absolutely, and we'll come back to that issue of where the markets are and what low interest rates mean for the longer term a little later. But now, from the general to the specific. Everstone and its large presence in India. How are things there? Walk us through your experience in India over the last decade and a half.
It's been, I must say, it's been a very interesting learning curve, and both my partner and I had sort of invested in many markets around the world, and because we were of Indian stock, we felt that we were uniquely qualified to invest in India without breaking a sweat, and markets humble you, and I think we learned a lot of lessons as we started our journey. And the first lesson that we learned was when we looked around and saw that the people who created the most amount of wealth in India over the last sort of 15-20 years have been entrepreneurs and not fund managers. In the US, you can point to many fund managers, private equity titans who've made a lot of money for themselves, in addition to entrepreneurs who made money for themselves. I think in Asia, and I speak not just of India but Asia, you will be hard pressed to point to more than a handful of people who've been very successful and created a lot of wealth in the asset management industry. And that's the nature of the beast that Asia is, where founder networks, entrepreneurs, those are the guys who seize opportunities and create wealth. And I think that was the first sort of realization. The second thing that we realized, at least from the first part of our journey, is that we found that whilst our capital was meant to harness the talent that we were backing, more often than not, we found ourselves sitting in the driver's seat. We thought we were sitting in the driver's seat by having provided capital, but with no steering wheel. The steering wheel was in the hand of the other guy, and kind of we had to go wherever he or she took us in that journey. And after about 3 or 4 years of this, we decided that this was not a game that we wanted to play. So if we had the capital, and whilst we don't know everything about every industry, our job should be to marry capital with talent and opportunity. That's kind of the trifecta in which we operate in. And we found that we were making the right sector calls, but for some bizarre reason, our calls on the managements we wanted to back at that early stage of our evolution were not that great. And it was very frustrating, because no matter how much value we wanted to add, very often we would get this from the entrepreneurs that, listen, in the value add bit, you just give me the ad, meaning the money, you keep the value. And so what we did was, we sort of a third of our way into this journey, so 4 or 5 years into our setting up our business, we pivoted away and decided that, listen, we will be owners of businesses where we will be responsible for hiring the talent and managing the growth, the profitability of the businesses going forward. And since that time, I think we've been well rewarded for the efforts, because then it is for us to either succeed or fail, and the decisions that we take are the good or bad. So that's been the one significant part of learnings of the journey. And also what's happened in India is that when we started in 2006, the notion that you could buy businesses, and this is typical of all of Asia, and it's true in most Asian countries except those in North Asia, and true even in China, that you can't segregate a business from its founder. The founders are defined by businesses that they set up in Asia, and they're so emotionally wrapped up in what they do that it's just very hard for them to give up their baby. That's the supply side of the equation. And the demand side of the equation 14, 15 years ago was that there weren't enough private equity firms waiting on the other side to receive these businesses, because the way the private equity world had evolved in the West, that concept still had to make its way over into Asia, and it made its way into North Asia, Korea and Japan a lot earlier than it made its way into South and Southeast Asia. So there was nobody to receive the ball if a founder wanted to sell the company. And I think what we've done is, from 2012, the markets have continued to evolve. We, along with some of our peers, have really pushed and provided the demand side of the equation, that we are here to catch your business and hold it and provide it with the necessary capability sets, capital and competence to drive it to the next level, and hopefully then pass it to the next rightful owner of the assets. And so that the first thing is that the markets in India and the rest of Asia have evolved, whereby today we have no issue. Not every conversation goes down that path, but there is enough from a supply side perspective. We can sit down and have sensible conversations with entrepreneurs to take over their businesses and run them as ours. So I think that's the big change from a private equity perspective that's happened. I think if you look at where India has evolved, we started investing in India when it was like a 1.6, 1.7 trillion dollar economy, and the power of compounding on a nominal basis has brought us to sort of 3 trillion. So in that, I think for our job is to find businesses inside that ecosphere which grow at 1.5 times nominal GDP, and if you grow, India's grows as 10% GDP nominal, depending upon where the real and inflation sits. If you can find businesses that are compounding at 15%, 70% of our job is done. Because then you have to sustain that momentum and then sort of eke out returns in terms of operating leverage and what can you do to make the profitability grow faster and so on and so forth. So as you look at India today, I think, is that your question, Taimur? How do we see India today? I think India is in a bit of it's in a bit of a tight spot. The fact that the $3 trillion economy will shrink by 5% to 7% is less of an issue for us, because people forget that the notion of cycles in economics, and when you have 10 years of undisturbed growth, whether the growth is 4% or 8%, it's very easy for people to just forget that cycles mean that a sinusoidal wave includes waves going down. So we don't worry too much about the fact that you're going to see, as part of this global pandemic, a 5-7% contraction of the economy. I think the issue that we have tends to be a slightly longer term, because anything that we buy today we have to hold for 5 years. And as we peer through the fog of all the noise there is on the pandemic and issues and slowdowns and shutdowns, I think what concerns us are two things. One, clearly the balance sheet of the individual that comprises this 3 trillion economy. How badly is that going to get affected? Because remember, India is still, unlike China of today, but unlike China of sort of 10 years ago, domestic consumption still is a big, large theme. It's a large populous country with a large economy. So if the balance sheet of the individual is impaired in any way, either physically, i.e. he doesn't have the earnings capacity, or mentally, as worries about spending that money and worrying about the longevity of his job and everything else and the amount of money he has to spend on healthcare, because health is kind of top of mind for everyone. So if the balance sheet of the individual and the propensity to spend gets impacted, that for us, as we are trying to feed in to that sort of 1.5 times nominal GDP growth, that is not a great environment for us. So I think as we look through this, I think we're going to have a rough 24 months till either a vaccine arrives or people learn to live with what COVID-19 has to offer in terms of potential for disease and sickness. So I think the next 24 months are going to be, from an individual's balance sheet perspective, somewhat complicated. The second thing which worries us, then the second balance sheet that we have to worry about, is the balance sheet of the country. And and that is sort of a contradiction. There's a dichotomy there, that the external balance sheet of the country with $500 billion reserves is in rude health, but the fiscal balance sheet of the country is in poor health. And when the fiscal balance sheet of the country is in poor health, even though I suspect the mandate to focus on inflation and on fiscal deficits, whilst it was embedded, the latter in law and the former in the monetary policy mandates that the Reserve Bank had, I just worry that in this global mayhem, I think those two are going to be sidelined. And if they get sidelined, the worries that we have is that stress is going to show up either on the currency or in some other or in ratings downgrades or in some other fashion. So I think the wiggle room as far as the economy is concerned is a little constrained. It concerns us, but I think that and a lot of people have, in our engagement with our investors, one of the things that has come up is, what if India lapses back into a 4 or 5% growth for a long period of time? we'll have to wait and see. But I think the world is a relative place. It's not an absolute place. So if India grows 4% real with 3% inflation, 4% inflation, 8% nominal, relative to the rest of the world, it's not that bad. On an absolute basis, India can't afford to grow 4% real, partly because just the demographics. So everybody talks of the demographic benefit that India has. It can turn into a demographic curse, because if you can't really get the economy to move, to create new jobs, that demographics is not going to help you, it's going to hurt you. So I think India has to sort of tread a fine line over the next 24 months in terms of how, given limited fiscal flexibility that they have, given that the rating agencies have sort of all are now on the fence from investment grade versus non-investment grade, and the fact that the personal balance sheets are going to get impacted. So it's going to be a tough sort of 24 months in terms of finding for the country and the individual to tread. What do we get paid for? I think our investors give us money not to invest in the macro but invest in the micro. So our job is that you take that environment and then use your judgment and skills to find assets that continue to grow. So in all of this, 4 years ago, as an example, Taimur, we pivoted to healthcare and IT services, because our view is that in IT services, India has an unmatched capability set, and healthcare was a more defensible sector, and we had no idea what was to come down the line, because as you look at by any metric, from a percentage spend on healthcare to just the physical infrastructure available and the needs of the populace, we just felt it was a good place to be. So we over-indexed our last fund into IT services and healthcare, and that's really stood us in good stead. And I think we'd like to, as we look forward over the next 24 months, I think that sector selection, I think, will continue to play out. I think the competitive nature of India from an IT services perspective will continue to be there. I think the world is going to pivot to everything very, very, very rapidly. It was no longer a choice that organizations have. And in that rush to actually move, we think that the spend to the detriment of all other segments is going to be massively towards digital enablement of businesses. And I think India over the next 5 years is going to be as much a beneficiary as it was in the whole Y2K movement, when the world pivoted into solving that problem. I think India is going to be a long-term beneficiary for that. So I worry about from an overall perspective on the economy and the macro, but I think we live in the micro. So we have to find, and I think there is enough to do if you look in the right places in terms of businesses that you could buy that could benefit even in this environment.
So Atul, your vision on healthcare and IT, of course, is playing out very, very well. Tell us about some of the other sectors where Everstone has large exposure in India, for example, real estate and logistics, and perhaps even the food and beverage side of the economy.
Sure. So real estate, going back on the history that we talked about, 2007, we started looking at the logistics industry to really find out where the value levers were and what really made sense and not. And we realized that one part of the value chain that just did not exist in India, this is as recently as 14 years ago, was high quality infrastructure on the warehousing side. So this is a $1.6 trillion economy that had 2 warehouses, more than 500,000 square feet across the entire country. And part of the reason was that India did not have a unifying GST rule, and you had local sales tax across states. So what you had was a proliferation of subscale distribution centers that were all sitting inside states. And we said, and GST was a law that was, the bill was being stitched together, and we said this is just a matter of time. So we looked at all of this and said, who plays in this? And there was virtually no organized player in this sector. So we decided to go long that sector, and that has been a prescient bet for us. And as we roll forward 14 years now, 13 years, 2007, we are the largest developer of industrial real estate in India. And whilst the GST bill, it took another 10 years after we started for the GST bill to come through, or 11 years. But what had happened was, I think industry started moving our way in terms of stitching and the use of technology, the use of efficient supply chain, and the need for large distribution centers continued to grow. And even without the introduction of the GST bill, and what we did is we caught that wave. We were the first ones. We didn't know how to build warehouses. We never built and constructed real estate before. So we found a great partner in the US who helped us with at least the first level of better understanding of the industry. Our partners in the US sent a partner of theirs into India to work with us, and we built the foundations of a fabulous business. And as we look back, I think we were lucky that we picked the right end of the sector, which is capital intensive. So what it does is it keeps a lot of the developers in India away from this business because they don't have capital on their balance sheet. Number two, the returns on a relative basis compared to residential or commercial are poorer, but they're long duration and more stable. So what that does is you have to put a lot more capital to work, and your returns are lower than, in theory, what you would get from a residential sector. So it keeps a lot of the competition away from the sector, because real estate developers scratch their heads and say, "Oh, you're making all this effort for so much return, well, why are you doing this?" And our view is that if you're building infrastructure that has 25, 30-year duration, and typically what would happen is your average leases are 9 years, but once factories get set and you are part of someone's supply chain, very rarely does that supply chain disrupt and move elsewhere. So we think that even though leases are for 9 years, these are in effect, leases forever, unless these businesses get disrupted or people shut factories, but that doesn't really happen. So as we look back, we've been, I think this has been a great success for us. As we've built a brand, we've built presence. We are probably amongst the top 4 real estate developers in India in the last 14 years. And, all of that comes from just sticking to the basics. You deliver, value for the money. We build these warehouses, we don't sell them. Most of our tenants are AA, AAA rated multinationals or domestic companies who are all sticklers for quality. They all want a high standard of product that you have to churn out. So I think on the real estate side, again, as we, and the example of the last 3 months trial by fire of the pandemic, all that's happened, I think the demand has only gone up. E-commerce is just exploding. And large global e-commerce firms that on an annual basis would tender up sort of 1 million to 2 million square feet of real estate. Tenders that are being floated right now are 10 million square feet a year of demand, as they see the massive pivot of this country from actual physical purchasing into sort of e-commerce. So that's the second wave I think we're going to ride up over the next 5 to 10 years in that sort of sector. The other sectors of real estate, I think, other than office with commercial, which has been on an absolute tear, I think on the residential side, things are going to be very, very difficult, partly because, the access to capital for a lot of these real estate developers is going to be poor. Non-banking finance companies that were traditionally the in many cases, sole providers of capital to this sector of the real estate industry are sitting in with impaired balance sheets and no hope of getting access to capital to manage their liability side. So we think that both the residential sector as well as a third of the non-banking finance sector is in very dire straits that requires a significant amount of fixing. So that's kind of our view on India and then real estate.
One more area in India where you have been active is green infrastructure. Tell us a bit about that.
So our commitment to climate change. About 2 years ago, a little over 2 years ago, the British government and the Indian government were hunting for asset managers to manage a pool of capital to be invested in green infrastructure in India. And this is one of Prime Minister Modi's key projects as to reduce India's reliance on oil, and therefore just the greenification, if that is a word that I can use, of Indian industry. So everything from generation into all other derivative industries, and it's not just putting up solar and wind generation infrastructure, but just what incremental industries can use green energy. Everything from mobility to waste to water. So the two governments came together, and they were hunting for an asset manager, and we, through a connect that we had, were approached by BP, British Petroleum, and one of their green infrastructure efforts called Light Source. And we partnered up with them, we bid for the mandate, and we won the mandate from the governments. So we have two LPs in that, two investors, the respective governments, and the mandate is, again, to look across investing in green infrastructure broadly. What was also happening in India was, is given the rapid scaling of both wind and solar, both those sectors attracted 99% of the capital coming in. And one of the things that the government wanted to do was, whilst that was fine, they wanted to broaden the scope of where the capital needed to be deployed in addition to generation. So, and with that mandate we set out, and we have now 4 verticals that we are focused on. So generation is about half the business. Mobility is another big element, which is electrifying public transportation infrastructure. So, both intracity and intracity. And, we've worked very closely with governments to put the frameworks in place for state governments then to offer tenders for public transportation, essentially bus networks, to use electrified buses to cut down on the pollution. In addition, India went CNG. They started using CNG for some of the public infrastructure.
Compressed natural gas.
Yeah, so that's compressed natural gas for 3-wheelers and for buses. We think that there is a great opportunity to set up a battery infrastructure across the country where you can just go and hot swap batteries specifically for 3-wheelers and buses. So there's a whole platform that we have set up that is looking at, in addition to providing electrification of buses, providing a nationwide network of hot swap batteries. But for that, it's a 2-pronged attack. You have to have users, as also you have to have the supply of these batteries. So that's one. And then waste and water is a big theme for us underneath that as well. How to use modern techniques for desalination, how to use modern techniques for water treatment, just to preserve. India will run out of water before it runs out of oil and gas, and its oil and gas reserves are pretty low. So I think how it manages water is a big issue for the country, and then we're engaged in trying to find solutions for that.
That's fantastic. Now, Atul, I know most of your eggs are in India, but not all. So just as a wrap up, give us a sense of beyond India, which markets you're looking at.
So if you play the themes, going back to what I mentioned, the more IT services and healthcare. So in IT services, I think what we are doing is we're spending a lot of our time hunting for actually businesses in the US that have backends in India or in other parts of Asia. So across companies that do IT services in the digital arena or healthcare arena that have physical presence this part of the world. So we're hunting for businesses there. It's a deeper universe to mine, and within that universe, there's a large Indian diaspora that is settled in our entrepreneurs who've scaled businesses and brought them up to a certain level and are either looking to monetize or have run out of steam to grow the businesses further. So those are proving to be reasonably good hunting grounds for us. So Indian diaspora in the IT services industry who have scaled their businesses and are looking for an exit or a partner. So that's one. On the healthcare side, again, India's capabilities on the chemistry, we've invested in businesses in India exporting to the US, but we've also invested in businesses in the US that are either doing research or manufacturing of the pharmaceutical products in India. And then within Asia, our focus is along 2 vectors. Food and food services we like a lot. We have that expressed in our portfolio. So for example, we are owners of Burger King and Domino's in Indonesia, and we really like the QSR sector. It's more science than art, and it is a reasonably robust, notwithstanding the models that will have to change to accommodate the pandemic with a high customer touch. We think that certain foreign brands or certain North American brands really travel well in most Asian countries in the QSR bucket, and we've had success in that segment. So food services is a big theme for us in the rest of Southeast Asia. And then healthcare remains a big focus for us even here, and that tends to be more in terms of services and products rather than healthcare services like hospitals. So healthcare and food here, IT services and pharma related services in the US. So That and then domestic consumption in India. So if you look at sort of the three pillars of our investment themes in private equity, it's the India-US corridor is one, domestic Indian growth is the second, and then on an opportunistic basis in two sectors in the rest of Asia. Which is why we have the physical footprints that we have between Singapore, India, the UK, and in the US.
Well, we're lucky to have you in Singapore, Atul. That was very insightful. Thank you so much for your time.
Thank you, Taimur. Honored to be here, and thank you very much.
And wish you and Everstone the very best of luck in generating lots and lots of alphas.
Thank you.
Thanks to our listener for listening in. You've been listening to Kopi Time. You can find all our research in multimedia by Googling DBS Group Research.